So good morning, good afternoon, good evening to everyone. We're in multiple time zones. We're here today to talk about due diligence of private equity funds in Africa. I will just change the private equity and call it private capital. That includes all forms of funds, not just private equity, it's venture capital and infrastructure, as well as other forms of private funds in Africa. We have a distinguished panel with us here today. Let me first introduce myself. My name is Hany Assaad. I'm co-founder and chief portfolio and risk officer of Avanz Capital. We are an asset management company that specializes in private capital in emerging markets, and we invest in funds and companies in Africa, emerging Asia, and Latin America. And I'm here to moderate this session. So we have today with us, not in any order, Nicholas Piquito, CEO of African Alliance Asset Management, Victoria Younghusband, partner in Charles Russell Speechlys, John Seymour, head of private equity and mezzanine finance in Sanlam Investments, and Paul Boynton, joint CEO of Old Mutual Alternative Investments. I'll ask each panelist to introduce themselves, to say something about their firm and their expertise in this business. So I'll start with John, since I'm on my side here. So John, go right ahead.
Thanks very much. Yes, so I head up the private equity and mezzanine finance operations of Sanlam Investments. Sanlam Investments forms part of the Sanlam Group, which is the largest insurance group on the African continent. We're currently quite active on the fundraising side, both in private equity and private credit. So looking forward to being part of the panel.
And Victoria, would you like to go next?
Yeah, sure. Hi, I'm Victoria Younghusband. I'm a corporate partner at Charles Russell Speechlys, based in London, although I'm also qualified in Hong Kong. I assist managers in fact, I have two roles. Sometimes I'm acting for managers in setting up funds, and sometimes for investors investing into funds. And we've recently closed a fund for Ascent with a lot of DFIs. So I'm very much, due diligence was a big part of that.
Nicholas, would you like to go next?
Sure. Thank you very much, Hany. Nicholas Piquito, the CEO of African Alliance Asset Management. We have been managing assets across the continent for 25 or so years, across all asset classes in the private and public capital markets. We've recently launched an impact platform that we're looking at targeting the space, around 1.7 billion in assets under management, and obviously seeing substantial demand for the opportunities across the continent in a world of free money.
Thank you. And Paul, would you like to introduce yourself?
Yeah, sure. Hi, Hany, and hi to the audience. Old Mutual has their alternative business is involved in a number of different vectors in the private capital space. We have a private equity franchise which focuses on Southern Africa, an infrastructure franchise trading under the name African Infrastructure Investment Managers, which has a Pan-African remit, a impact fund team which focuses on funds that have both a financial objective as well as a clear impact objective. And in that regard, we've kind of launched funds in three spaces: affordable housing, affordable education, and retirement accommodation. We also have a hybrid equity team who are involved in the sort of mezzanine debt space, or the super senior space. We have a minority interest in an agri manager, Pan-African agri manager. And then lastly, we run a fund-of-fund program, which focuses both on African funds, and also it has a global remit. And in aggregate, we have about $5 billion under management across those different spaces.
Thank you, Paul. So before we start, just to tell the audience and everyone there participating, please post questions in the Q&A in the chat part, and we will address them as we go along. And any comments you'd like to make or otherwise, put them in the chat. We are monitoring the chat all the time, so we'll be able to participate this way. My first question is to Paul, and it's about, so before I get there, let me tell you that we're going to cover fund selection. Why do we do due diligence on funds? Then we're going to go to the components of a due diligence. And we're going to talk about a number of subjects within the due diligence, including legal aspects and the ESG aspects and governance. So it's a full range of topics that we're going to cover in this session. So the first question is to Paul. It's about fund selection. So how do you find the right funds to focus your attention on when there are so many to choose from? Just to give you a number, before the COVID pandemic, there are about 50 or so fund managers fundraising in Africa at any point in time. And so how do you choose the ones that you want to focus on? And I'll just give you the full question and you can answer. When selecting a fund to invest in, what do you look for in a fund and a fund manager? And then what are the initial criteria considered to identify that funds that you want to invest in that will outperform the market? And alongside the same theme is, what in your view are the best indicators of a fund's future likely success when you're first looking at them before you even do the due diligence? Paul, all yours.
Okay, Hany. Look, I think, top down, I think critical for us is the investment thesis. So what is the manager, looking to take advantage of in the market, and how have they scripted that investment thesis, and do we buy that investment thesis and believe it has credibility and traction? So that's the first piece. The second piece, I guess, is the ability to execute, which encompasses, I guess, a range of issues. But, the ability to execute is, will there be sufficient deal flow in this opportunity set? Is the manager resourced to take advantage of that deal flow in terms of, will it be able to put its foot on the deal flow, access to deal flow, ability to execute, ability to add value through the tenure during which they're going to remain invested in that business? What resources does the manager have, for adding value in terms of debt capital market expertise, in terms of M&A expertise, in terms of sort of digital transformation expertise, whatever the value add thesis is on the businesses or the opportunities being acquired? Does the manager have a clear demonstrable capacity in that regard? And then finally, of course, the ability to exit, and that's a much often everything goes swimmingly until the exit, and then the things can confound you. So that ability to manage exit well, to have thought through what the exit opportunity set is, to be thinking about how you manage a business to exit over 3 or 4 years is also very important. And in assessing a team in this regard, it's quite critical to look at the skill set, the diverse skills that are on board there, the way the team knits together, have they hung together for a while, and then what is their track record? So I guess that's a bit of a summary of the whole space. Quite a matzah pudding in a way there, all that lumped together. But out of that sort of a cooking pot, you need to sort of frame an opinion.
Thank you, Paul. Let me address the next question because you covered it quite well, the first one. So why do we actually do due diligence on private capital funds and fund managers? And let me start with Nicholas. Why would you do due diligence? What's the value of that, and how do you do it? And if you can just describe a little bit more about why is it so important to spend so much time and money and whatnot on this process when you're selecting a fund?
Sure, Hany. I think what's interesting. Sometimes in this business we tend to gravitate towards complexity. I tend to take a more simpler view on the rationale for this. So in my view, essentially, here's what it comes down to. What you're looking to do, your entire due diligence process, whether you're looking at process, whether you're looking at team, whether you're looking at the ability to manage portfolios, it essentially comes down to finding managers that you think can play around with the statistics of their return profile. In other words, is the manager able over time to run his business and to manage your assets in a manner such they can cut off the left-hand side of the tail? That would be the downside, and allow the right-hand side of the tail, that would be the upside, to run unmitigated, right? So there's a name for that. That's called asymmetry, right? It's essentially a question of cheap optionality. So for us, fundamentally, everything that you would do from a due diligence review, from a due diligence basis, it's about looking to put yourself in a position to understand whether over time the manager is able to generate an asymmetry of return. That's fundamentally what it's about. Everything else is really just a means to an end. Now, that's a very high-level description, and clearly it can get very technical, and Paul's touched on a number of the specifics of that. But for me, fundamentally, that's what it's about. Different managers or different businesses will have different ways of doing that, different processes, different techniques. But fundamentally, I think that's what it comes down to. And everything that we do typically is premised and founded on that approach, first and foremost.
Thank you, Nicholas. John, do you want to add something to this? On why would you do due diligence, or why do you think you're in the investors because you play both roles? So why do you think investors would be interested in doing due diligence on funds?
We see it quite simply. I think, first of all, understand the mandate. I think Paul made a very good point there. But then there are three things. It's really the competence of the manager. Are they aligned in terms of alignment of interests? And then lastly, is there a compliance factor? So those three issues we think are critical in terms of the due diligence.
Thank you. And Victoria?
Yeah, okay. I think first, I would say if you're managing other people's money, you ought to do due diligence anyway as part of your responsibilities. But what you get out of it as a lawyer, you do need to look at the legal structure. Hopefully, if all goes well, you never have to look at the LPA and other documents again, but it doesn't always go well. In particular, you have to look and see, does the waterfall work like it is described and like it is intended? And has the manager got all the legal and regulatory licenses it needs, for example? Is the tax structure efficient? So it's I would say it's probably a risk point doing good due diligence.
We have one question from Gavin Ryan, but before I ask this question, I'm going to just tell you the way we approach it as Avanz Capital is we look at what Victoria just mentioned. We look at what are the risks and how can we manage those risks ourselves as an investor in a fund, and are the risks worth the investment first? So we have to get over the risk factor first, and then we look at what's the opportunity. Can this manager outperform the market? What's unique about the manager, etc.? That will give us that outsized return we're looking for. That's higher than the public markets. Otherwise, you just put our money into public markets, all of us. So it's looking at the risk and return at the same time, and how we approach it is the whole process of the due diligence. But just to build on the question that Gavin Ryan mentioned, and I'll read it. How can someone who has never been a GP be qualified to do any due diligence on private equity GP? So I'll start with Paul, since you have both sides of the equation, being a GP and an LP at the same time. How would you address this question?
Look, I mean, I think what's implicit in this question is experience as a GP is useful. I wouldn't dismiss that. I think that is a point, but I don't think that it's only someone who's been a GP who's able to, properly do a commercial due diligence as opposed to a compliance or risk due diligence on a manager. I mean, I do think commercial due diligence is around, testing for repeatability in terms of, outcomes, and is the manager in a position to be able to do that in terms of, what deal flow access do they have, what skill set sits within the manager in order to, add value. These things are things that can be tested on interrogation. And I do accept that if someone's kind of been through this themselves, there is some further level of insight perhaps, but nevertheless, I do think that experience is a huge driver of skill in this regard. And the experience that's ultimately required is assessing many different managers. So when you're assessing your 30th manager, you have a very good feel for whether this is a good shop or not, and where the weak points in the shop might be. And that's come about because you've turned over the stone so many times before that actually when you turn over this stone, you've kind of got a good feel about it. So it is very much an art, I think, but I think also discipline does help here, and being very rigorous in terms of this kind of attribution. I think the really great fund of fund managers have deal attribution right back to the individual over the last 20 years on a huge data set. So they can look at any transaction that's been done, for instance, in the UK, and say, who was stapled to that outcome for good or for bad kind of thing. So, that level of insight can be obtained just through diligence and whatever. It's not, so there's lots that can go to creating a great, a great outcome in terms of a commercial due diligence.
Thank you, Paul. Before we take the next question, let's just move on to what are the components of a due diligence that you would do. So if you just go through the different parts of the due diligence work that's required. So now assume you've made the decision that you're going to pursue one fund and one fund manager to get to learn more. You made the decision to start the due diligence. What do you look at? And I will leave it. Who would like to start? Okay, Nicholas, what you like to start with this one?
Sure. Yeah, sure, Hany. I mean, there's so much we could talk about. I will just choose really one or two and give everyone else a chance to chip in. I mean, I would go back to what I said first and foremost, which is essentially the risk management element of it and the generation of asymmetry. I think that's important, and that's fundamentally a downside risk management component. So that's the first thing. And then secondly, from an African context, origination, right? I mean, the reality is the problem that we have today in terms of deploying capital, it's not a capital issue. It's not a capital raising issue. The world is awash with capital. It's a deployment problem that we have. In other words, how can you build a pipeline of bankable, monetizable opportunities? So for us, that's typically one of the first areas that we will look at as well, right? Because, the management of the portfolio, putting this stuff together, it's really commoditized to a large degree, right? But generating the inputs into the portfolio for us is always one of the more important issues. So those are two off the top of my head. Those are two of the areas that we would look at specifically first.
And John?
Yeah, I think that's the commercial side is critical. I mean, just to go back to the previous question, I think one can also gain quite a lot of insight from interrogating previous deals done, speaking to investee companies, speaking to, for example, finance houses who've been part of deals with the team, looking at attribution analysis of those deals, trying to map that then against, for example, the origination pipeline, which is being presented as part of the application. So I think that's kind of the front end commercial side. I think what you then have to look at is more sort of from a process point of view. So from a, let's just say, risk management, regulatory framework, tax and legal. I think there's some very important elements there, and I'm sure Victoria can talk to that in quite a lot of detail. But then there's also softer cultural issues, I think, which is maybe a point which was made earlier, sort of how long has the team been together? How do they function together? What is the leadership structure like? How do they, on a team basis, how are decisions made? And then lastly, I think diversity and inclusion has also become quite important in the due diligence. So I know for ILPA's latest sort of framework on the DDQ, that's a separate section which is quite detailed.
Thank you, John. Victoria, would you like to address this question? Plus, if you don't mind, also addressing the question in the chat from Alex Rodriguez.
Right, let me look at that question in the chat. I'm not sure if I've seen it, so I'll
read it out. But if you want to start, and then I'll read it out.
Yeah, and thank you, John, for letting me segue into the legal side, which, I mean, I guess it starts with looking at what comes out of the DDQ and the data room so far as it concerns the fund structure. that everything is duly incorporated and licensed. And are there inconsistencies between the PPM and the fund documents? If so, why? Quite a lot of questions can come out of that. Looking also at the tax structure, and in cases where there are seed investments, have they been properly constituted? Are there any sort of minority interests that could affect the fund's holding? And I suppose another point which hasn't really come up yet is, what's the identity of the other investors? And is there a risk of defaulting investors, for example? And perhaps the question, Hany, that I haven't managed to find on the chat.
Okay, so from Alex Rodriguez, is a GP separate legal entity, or is a private equity fund manager, or is that the management company? Also, what is the legal entity of the typical PE fund? Is it an uncommandité partnership, and if so, who are the owners of the partnership? Is it the LPs and the GP? And if so, is there a share of ownership based on contributed capital of economic interests, the 80-20? So a lot of questions, but maybe if you can just summarize it, because this is getting into the details, and we want to stay more general.
Let's say it's a limited partnership, and the general partner has all the liability, and so the general model is that the general partner is an SPV, and all it does is act as general partner of the partnership. So the liability stays with it, and it's not really an entity of substance. The manager would have a separate contract with the partnership. And it is correct that limited partners have a share which is proportionate to their contribution, but this is separate from the manager's, the carried interest partner, which is the manager vehicle that will have an enhanced share after payment of a preferred return. I hope that's a very simplified explanation. I hope that will do for the moment.
May I just add to that, Hany? I think Victoria is absolutely correct, but I think, Alex, the point I think here with the GP is it is a creature of the manager generally. So the manager has the management contract and will look after the investments on behalf of the investors who are the LPs. And you know, the functioning vehicle that affects decisions is the GP, but the GP is essentially a creature of the manager. So although there's a legal distinction drawn between the two, I think philosophically you're kind of looking to the same group of people in terms of that functionality, as it were. Victoria, I might have got that legally incorrect, but
no, you haven't got it legally incorrect. The GP is set up by the manager, and the directors are likely to be manager people. Occasionally, you might have an independent director.
Thank you.
And then maybe just to because I'm not sure, and Alex, you must just re-ask this question if we're not addressing it incorrectly. But I think the way the economics work in the fund generally is that, you know, distributions are made in the percentage of contributed capital. So whatever the GP has put in, whether it's 1% or 3% or whatever, is the returns that the GP will earn until such time as the investors, being the LPs, have earned their preferred, you know, their threshold return or preferred return, which is normally something in the region of 8 to 10% in dollars. So at that point, you then get into the 80-20 share. There is a, you know, all partners earn equally until you hit the threshold return. Only after that point is there a disproportionate distribution in favor of the the carried interest vehicle, which is essentially the manager aligned sort of incentivization structure.
Thank you, Paul. This is great. Anyone would like to address the importance of doing an integrity due diligence, which means checking out not just the fund managers, but everyone associated with the fund? Does anyone do this, and how do you do it?
I can go on that. I think that's critical. It's especially now. I think if you take, for example, some of the failures we've seen on the continent in terms of managers, I think it's made it very, very critical to do that. There are now firms which specialize in doing that. So, I think in the past, sort of people would generally use common searches, perhaps reference checks, etc. But I think there's a need to go a lot deeper on that. This is typically a 10 to 12-year relationship with a manager. So one should definitely consider that upfront.
That's great. Let's address another question that's very important for both investors and fund managers, which is the question about track record. And let me separate the track record question into two. So you've got first-time fund managers, and how do you assess their track record as a team? And then established fund managers, whether they've been doing this for a while in the same continent, same countries, or otherwise. How do you assess their track record? And let's just make another one, which is a fund manager who's been successful in another region and comes into a new region, and how do you assess that track record? So who would like to start on this one, on track record?
Hany, if I can jump in there quickly, I think this ties in with the question, or one of the questions that I saw coming through from Gavin, who I think is asking some pretty pertinent questions here. And Gavin's question was, well, essentially, how much credence can you place on the notion that someone essentially can cover all of Africa, right? And I think they're related. So, for example, at African Alliance, we tend to focus on Southern and Eastern Africa because that's where we have capacity, that's where we have on-the-ground presence and expertise. But getting back to your question, I mean, by definition, a first-time manager doesn't have a track record. So really, there's not a lot you can do if you're looking at analyzing track record, right? Then you're looking simply at process and team and so on and so on. And I think that is fairly difficult. What we have found historically is managers moving into different areas. Let me give an analogy here. It's really quite simple. You have prop traders that sit at big global investment banks. They do very well. They generate a name. They then leave to start their own hedge fund, and generally within 3 years they blow up, right? And that's because we tend to underestimate the impact of knowing the area you're in and the supporting infrastructure around you. And our view would be quite similar in terms of moving across regions. So, for example, we have seen numerous big international players with emerging market expertise moving into the African space, right? We think that is something that generally is going to end in tears.
And Victoria, you have addressed this issue probably in the legal side. How do you assess the track record? Because there's also the legal side of it, which is the attribution of a track record. As you know, the SEC in the US requires formal attribution of a track record if somebody is going to port the track record from one company to another. So if you can address those kind of issues.
Sure. I mean, the first point, which you've just raised as well, is we always ask whether someone has permission from their previous employer to use their track record. And actually, it's also a point acting for a manager that I put into the fund management agreement, that fund manager can use the track record of that particular fund when they cease to be, when and if they cease to be manager of it, because it's really important. How do we assess? And as lawyers, actually, it's quite important for us for a first-time manager, because lawyers tend not to get paid unless the fund raises money, and the first-time manager doesn't usually have sufficient funds to give you a meaningful fee unless they raise the funds. So we have to look very closely to see, do we think they're credible? Are we prepared to invest the considerable amount of time and loss of other opportunities by working with those managers. And so it's probably many of the things that Nicholas is looking for, and the other panelists. Are they credible? Do they have the deals?
Okay. Let me enlarge the question again and to address another Gavin Ryan's question about how can you be a fund manager across all of Africa. So we've seen successful fund managers do all of Africa, but they actually normally start, this is not normally their first fund, it would be their second or otherwise. But they would have the teams that come from different parts of Africa or that speak different languages and different cultures and whatnot. And they may also have multiple offices across the continent. But there is this difference between being a pan-African or a regional fund or a country fund, which we're going to also talk a little bit more about. But just to give you an idea, since we have somebody from India on the call, Samir, Africa is actually smaller as an economy than the entire India. So the entire African continent is smaller than India. And India is very, very varied. There are 34 languages with multiple ethnicities, etc. So it is not a unique thing to think about an entire continent. The big difference between India and Africa is India has one regulatory system and one set of regulators, etc. In Africa, you've got 54. So that's the biggest issue, is that you're dealing with very different markets within an economy that's smaller than one country. So it's how to do this and knowing how to work in those countries and multiple systems and whatnot that is the key success for the GP. But we always assess for Avanz Capital, we assess their ability to work in the countries that they say, that the fund manager says that they will target. In terms of track record, anything else you'd like to add, John, on this? It's a very important topic that a lot of people stumble on, because if we say we're not going to look at the first-time fund manager because they have no track record, then we are limiting ourselves to fewer. In general, there are more first-time fund managers in the market than established fund managers any 1 year. And then obviously there is the triage that happens. But knowing how to assess this track record becomes really important, and getting into the details of it. So how would you do it? I mean, the technique itself, how do you actually assess a track record?
Yeah, I think maybe just, so there are two questions. On the first, in terms of the continent, I would say that what we believe is two things. One is, if you're a thematic investor, so for example, you want to focus on consumer goods or digital infrastructure, whatever the case may be, I think there's a very strong case for being sort of multi-country focused, or whether you look at the 3 or 4 quadrants. So I think that's certainly the case. But irrespective, you definitely need feet on the street, as we say. So your in-country presence, we don't think you can suitcase invest. You need to actually have the presence on the ground. Just the second part of your question around assessing track record for a new investor or for a first-time investor, we think there's probably 2 ways to do it. The first one is to look at the Venn diagram between the various investment professionals. So to say, what is the relationship been outside of a track record between the parties? And then more critically, what is the Venn diagram with the investment committee as well? So what is within the investment committee and then between the investment committee and the team? And I think it often gives you some comfort. And probably the most important side, though, is looking at your kind of the origination pipeline. So look at the transactions which are there and how advanced are they, just to get a flavor for what the team can do.
And Paul, do you want to add anything on track record before we move on to the next question?
Yeah, look, I'm sure that the answer I'm going to give is not going to be popular, but I think a track record is important because it is important. And actually, a fund manager who's raising their 3rd fund is actually a much less risky proposition than a fund manager who's raising their 1st fund. So no doubt it's possible to interrogate things around a first-time fund manager. And, we should be looking at the opportunities. But, there's a profound set of circumstances that have been worked through in a manager that's raising their 3rd fund. A team has gelled, they've managed to work through the difficulties of 2 fundraisers, they've, deployed capital, they've realized some assets. These things, each of them are milestones that are quite, formidable and challenging, and so it's very important that data is on the books in a way. So just on the Pan-African thing, I think I would support John on that. I do think that certainly our infrastructure franchise, which is Pan-African, we have offices and kind of feet on the ground in Cape Town, Johannesburg, Nairobi, Lagos, Abidjan. And the piece we're missing maybe is North Africa. So I would accept that actually our ability to execute in North Africa is probably compromised to some extent as a result. And hopefully at some point we'll manage to create an office there as well. But I do think that the advantage of being Pan-African is you're seeing a much richer opportunity around deal flow. And I do think that ultimately it allows you to build a better outcome for investors, having access to a broader opportunity set. I think just maybe I can take the opportunity just quickly on Alex, who's refined his question on the GP, and I can just quickly chip in on that just to help him there. And that is, to be a black fund manager, to be defined as a black fund manager, you need to meet the threshold around 50% BEE participation, as it were, at many different levels. So it's at the ownership level, it's at the sort of carried interest participation level, it's at the board level, it's at the senior management level. So, that thing needs to be looked at holistically at all the important levels within the manager. Thanks, Hany.
Perfect. Related to this is a question from Somendra. What are the indicators, attributes to be checked for bankable investment thesis, particularly for first-generation fund manager in Africa, without having demonstrable track record as a fund manager? I think we've discussed this, but if you want to elaborate on, anyone would like to elaborate more on this specific point. So the specific question is, what are the indicators, attributes to look for? Anyone would like to try this? So for us, I'll tell you very quickly. For us, it is the ability to make an investment, i.e. find, as Nicholas said, you need to find the right investments, so which is the origination part. You need to be able to close the investments. So we look at the attributes of how they're able to close investments, i.e. make the investment. And then we look for how does the fund manager generate value within this company to make it grow faster than any company within its sector? Because that's what you look for, is the outsized growth and potential for profitability. And then very importantly is the exit, the ability to demonstrate that the fund manager is able to sell a company at the right time and not to say, oh, I cannot sell right now because I'm going to be leaving a lot of value on the table and it's too early to sell. I hear that a lot. And that's not the private equity model that we pursue. It's sell at the right time and make the money for the investors and move on to the next investment. So it's the ability to do all of these things. Each one of them is an indicator of how the future success of the fund manager in doing that. And if I can just move on to the next question.
Hany, maybe I can just add one point to that. That is, I think that the other piece that I think is very important is culture. And I think that first-time fund managers sometimes underestimate this, that actually making sure that everyone on the team is facing in the same direction, believes the same issues, has bought into the same investment thesis, the same framework, the sharing of economics, how you go about life, whatever. This is where first-time fund managers, in my experience, have come a little bit unstuck. They haven't actually got the ground rules right in terms of, as a team, how are we engaged and what are we about and what drives us and what's the glue that holds us together? And have we had all the difficult conversations that should be had before you go live, as it were? And I think if first-time fund managers spent, because, the investment thesis they found is compelling because they've left their jobs to go and have a tilt at this thing. But have they found each other and are they aligned and are they, committed in that way? I think spending more time in that space would be very useful.
It's interesting, Paul, because I've certainly seen that investors are very keen to know how the carry is allocated amongst the management team and to make sure that everyone is incentivized in the right way. It's not credible if you're putting someone forward as an important member of the team and they're not getting remunerated, they're not getting the share of the carry that is commensurate with their position.
Let me also add to this, because it also answers another question that Eckhart has answered, even though it's the last question I'm going to, which is the whole aspect of ESG and impact. We don't distinguish between impact and financial returns, i.e. it's not one at the expense of the other. So if you have a higher return, it has to be with a higher impact. It cannot be one at the expense of the other. But ESG is an integral part of what we do, right through from due diligence all the way through. And I would divide them into the E, S, and G, and they're very different. And how do we manage that is at due diligence, we do a full ESG review. We identify what impacts we can get out of a fund. The fund manager would then tell us, these are the impacts we would like to achieve. And then we set the measurements for those impacts so that we know what has been achieved year on year in terms of what are we trying to achieve. And impacts are quite varied, and they have to be thought through and well articulated. They can be climate impact, they can be social, i.e. people impact, and they can be governance impact in the sense of transparency and better governance of companies, etc. So we take that as an integral part of what we do. It's not a separate one. And therefore, when we talk about returns, we talk about investment returns, return on capital, and return on impact as well. So the two go hand in hand. Just the final word on this is that we use the Sustainable Development Goals as a guiding principles and the way to frame the whole impact story. And along this, I'm going to ask Victoria, how do you see ESG due diligence being done?
Well, quite often by specialist reporters. But as you say, E and S and G are very different. On the governance point, that's probably actually very much a legal point. But you have to make sure that what they say is actually what they do, which isn't on the ground. The E and the S, we've seen reports and then actually quite often action plans, because investors may like the fund, the manager, and the concept, but they want to actually to see hard goals, and so you will see operational plans with targets and deadlines and responsibilities. We're also, I think, every manager now has a dedicated ESG officer with a team reporting to them below. So it is important. And can I also add that if there is a European manager involved, there is specific ESG reporting required by recent EU legislation and nascent legislation in the UK as well. So it sort of flows through to the underlying investors.
Switch topic a little bit, and I'm going to address many of the questions in the chat in a minute. But John, since you play also the role of the GP and funds in a fund, and you are currently fundraising, from a fund manager's perspective, what are you seeing investors focusing on during due diligence? And then how do you prepare yourself as a fund manager for a due diligence by an investor in the fund?
Yeah, it's quite interesting because there's been a very strong focus on ESG and impact. So we also see exactly the same as what you and Victoria were saying. We very much see the E, the S, and the G as being separate. But from an impact point of view, we're very focused on jobs. So under the SDG, we believe in sort of job creation, preservation, inclusivity, and job quality. So I think what investors are looking for is for that to flow through from our investment processes, so from origination through to investment monitoring. So we've seen an increased scrutiny from that perspective. a very, very strong focus on governance and compliance. So I think, again, just to go back to some of the failures we've seen on the continent, I think there's maybe a stronger leaning towards the due diligence on that. From our perspective, we form part of an institution, so I think there's some institutional due diligence as well, which gives investors some comfort. In terms of COVID, I think COVID's really impacted most due diligence processes. So we're spending a lot of time with potential LPs. So it's not first time together in a meeting, but it's very much a more frequent interaction than historically. And what we're finding them focusing on is also investments which are in the pipeline, trying to understand our investment philosophy, the way that we approach ESG and impact in terms of those investments, are they proprietary, etc. So that's where we're seeing at the moment. So,
John, you covered a lot of topics that we can go into more details, but I'd just like to ask one question from Melissa. What are some of the red flags to look out for when assessing a fund manager, from performance of previous funds or deviation from KPIs that would have been agreed with the previous GPs? Is there a requirement for LP capital contribution towards the fund? And John, since you were talking about that, if you want to start addressing this particular point, and then we'll move on to Nicholas.
Yes, I think red flags would definitely be investments outside of mandate. So it would be to understand, first of all, what is the core mandate, and then to understand within the track record that was generated, what were those investments. So, for example, if you were thematically an industrial investor and your outside investment or outside returns were caused by something on the fintech space, it's obviously, stating the obvious, a red flag. So I think you want to consider that. I think you also want to look at, for example, how track records are assembled. So very often what we've seen is, for example, in new teams, track records being imported. And I think that you obviously can't do in certain jurisdictions, but in our jurisdiction, you need to check exactly that attribution and how that was done.
And Nicholas, would you like to add to this?
Yeah, I think that, excuse me, Hany, I think that it's interesting because the COVID perspective, and we've touched on that. My view on COVID is that essentially COVID has essentially acted as an accelerant for a lot of the changes and some of the reforms that we've seen, right? So whether it's, some people have touched on, I think there was a question earlier on managers not making, or investors not making allocations to underlying managers as a result of COVID and not being able to meet teams. We think that COVID has acted as an accelerant, and we think that that's going to change the way that some of these managers are assessed going forward. We also think the increasing prevalent use of data is obviously something that's also going to be increasingly being important going forward. So I think the situation is quite fluid in that respect.
Okay, and to build on what John said in terms of also COVID and due diligence of investors, Paul, in this environment where people are restricted from travel, where investors are restricted from travel, and to actually due diligence of a fund and a fund manager, and we know the importance of meeting the fund management team because we're in a people's business and you need to feel the team and address the questions we were just talking about. It's not just about making investment into a fund, but is this team the right team? Looking somebody in the eye and spending time with them. We can't do that in the COVID world. So how do you handle, and how did you see investors handle the restrictions? And as Nicholas said, maybe we've now looked at different ways of doing things, accelerated the reforms in a certain process, but how did it change for the due diligence process itself?
So I think, look, no doubt, personal contact is important. Although I remember back in the day when I was a listed equity manager, one of my colleagues felt it was more important not to meet management rather than to meet management because, management have a particular story to tell. So, but what we have seen, I think, is that COVID has, been useful in some ways. So no doubt it's difficult to meet, and certainly we found it easier to look at, as an LP, we found it easier to make commitments to managers where we have had previous personal interaction with them historically. Even if we haven't invested in a prior fund, if we've met them historically, it's been easier maybe to progress those relationships through COVID than if you haven't met them. But we have made some allocations to managers where we have never met them before through this period. And I think where people have stepped up, I mean, in some ways the process has become more efficient because, you know, the data rooms have become, you know, the key focus area. And you know, if that's well populated, then a due diligence can be executed more effectively. You know, quick turnaround on requests around information that may not be in the data room has also been very effective. I think the process is also a lot more efficient. I mean, we're an LP managing, you know, as I mentioned, both a global investment product as well as an African investment product. So, you know, the ability to not travel has meant that, you know, we've actually become more efficient because we're spending a lot less time traveling, which obviously consumes a lot of time. So in some ways, that's a good outcome, and hopefully, possibly to some extent, some of that remains going forward because it's, you know, it's environmentally positive that, you know, to have less of a carbon footprint in terms of what you're doing. We've spent more time focused on references with other investors. So that's another piece of our process that has modified as a result of this, and we've actually kind of come out of that much richer. We also have, you know, the team sitting in on those conversations rather than historically those conversations would be a one-on-one. Someone would reach out to, you know, if they knew them or whatever, we'd reach out to. But now we kind of set up a Teams call, which is not seen as kind of weird in this environment, and, you know, 3 or 4 people can sit in on that call and read, you know, the body language, as it were, in terms of that conversation. So it has actually, you know, mapped out in some ways quite positively. But you know, I'm sure we all look forward to being able to interact, you know, properly going forward with managers and really build those deep relationships that are important, and to understand spaces better. I think. I mean, I don't think that this sort of situation is sustainable, although we can maybe take some learnings from what has been the case over the last 18 months.
Thank you, Paul.
Hany, if I may just jump in there very quickly, I think that I mean, I couldn't agree more with what Paul has said, but I would just add to that very quickly, and it might be a little bit of a heretical statement, right? But, you know, just as if you look in the listed equity space, for example, we know that there is actually very little evidence that meeting with management or senior management at a company provides any additional insight or ability to predict stock prices going forward. And the reason for that is very simple, right? Because these are typically smart people. They've got a very good story to tell, as Paul has said, and they know what needs to be said, right? So I don't think the situation is all that different here. And that's why when I go back to what I said earlier about COVID acting as an accelerant, this is where I think you're going to see some structural changes going forward. And I think you're going to see technology playing a larger role here, right? So absolutely in-person meetings, you know, face-to-face contacts, the relationship building is clearly important. Clearly that will never, ever go away. But I think COVID has changed the game. And the point Paul made about data rooms, I mean, we've seen it in our own business. We've certainly seen it in other underlying managers, more of an emphasis on data, more of an emphasis on both quantitative and qualitative data. Now, you know, you can say whether that's machine learning, whether that's any of these fancy new topics and terms, we think that is fundamentally changing the game going forward. And I think we shouldn't underestimate just how impactful this may be if you look forward 10 years.
Thank you. This is great. We have lots of questions and we have very little time left. So I will just ask. So there is one that, Chris, yes, it's you, Victoria. And the question is, diaspora are active in business creation on the continent. How are the international tax favorable jurisdictions handled best when activating capital and facilitating African tax revenues? Is this an important consideration for the fund as a whole or LP specific needs?
I think it is an important consideration. It's the first thing you think about when structuring a fund. Where do you domicile it? And it's interesting because of the FATFA blacklist, because Cayman was a very, and still is to a degree, a favoured domicile. But they certainly were told by some investors that they wanted a Cayman manager to be moved to Mauritius. Mauritius is now on the FATFA blacklist, although they're trying very hard to get it off. And in our view, it doesn't seem to bother the DFIs so much, but it does make actually, it causes problems for lawyers, for example, on their compliance departments, because you have to do enhanced due diligence on anyone going into an entity that's domiciled in a blacklist country. But tax, I mean, that's sort of blacklisting. Tax efficiency, obviously, it affects your returns. So you want to make sure both at the investment entity level and the underlying investments that it's structured in as tax efficient way as possible. So we usually see Mauritius intermediate holding companies, and then the investment itself in an entity domiciled in the country in which you're investing. But I'd be interested in the other panelists' comments on this one.
Let's leave it at that because we only have 3 minutes, and there are quite a few questions. One of them that is a topic that we wanted to address that Celia has mentioned. Given the collapse of Abraj and other PE failures, what extra DD steps have the LPs added to their processes, and etc.? I won't read the rest of the question, but just on that point, what we call operational due diligence has now taken a huge significance as part of the due diligence process. And operational due diligence now encompasses all kinds of things that were not a normal part of due diligence before. And given the lack of time, I'm just going to maybe say what we do. So we look at everything from the cash management to cybersecurity to code of ethics to managing the firm itself, managing the fund itself, so the management of it, not just the investment side, that have now taken a huge importance. And so this is an important part of the due diligence, has changed dramatically since the past. How is reflected in the LPAs and shareholders agreements. Victoria, if you want to address this very briefly. We have only 1 minute left, so I'm just trying to be cognizant of time.
Well, certainly the LPAs require the GP to be absolutely transparent and have very good processes against bribery, corruption, terrorist financing, etc.
Thank you. I think we ran out of time. So there are many other questions, very interesting questions. There's questions about ESG and impact, which we can spend a long time talking about. They are an integral part of what we do, and it's not just a side activity. There are questions about the co-investments, which is another important part of what we do and how that's managed. There's another entire topic on its own. But I'd like to thank very much the panelists, Victoria, Paul, John, and Nicholas, for their amazing contributions, and to thank the participants for their questions and active participation, actually. I think we have at one point we reached 90 participants, which is a large number. And I thank you all, and look forward to another session like this in the future.
Thanks, Hany.
Hany, thank you to you, and thanks you to everyone that participated.
Audience as well.
Yeah, thank you.
Absolutely.
Thank you all, and we're
thank you all.
Dead on time. Thank you. Bye-bye.
Bye.
Bye.